Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, August 8th, 2026. Hey, how you doing? I hope you're doing well. I hope you are having a nice weekend. I hope you had a good trading week last week. And thank you for coming to my weekend review podcast. I hope you're going to find it helpful and that you're going to learn something today. So, the format for the podcast today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades, all the positions that I have and that I made last week. We're going to talk about when I entered each trade, why I entered the trade, what the signal was, the signals were, the confluences of signals. And we're going to talk about how I position size based upon the market's current volatility. We're going to talk about how I place my emergency stops, where I place my end of bar stops, how I take partial profits if the market starts to move in the direction that I want it to, what happens when I get to trailing stop mode, and then ultimately how I am going to fully exit the trade. So it was a really good trading week last week for the bulls, so hopefully you were in that camp as well. But yeah, we're just going to talk about when I entered the trade, why I entered the trade, and really most importantly, how I am going to manage the trade going forward. After that, we're going to talk a little bit about trader psychology. It always is the most important skill in trading, is the ability to create a plan, which is not that difficult. The difficult part is following the plan. You can have the best trading plan in the world, but if you don't follow it, what good is it? So I've been trading for over 30 years now. I I meet and talk and speak with traders all over the world on a regular basis. And what I have seen is that the majority of people that struggle with trading, they don't have a process. And even if they do, they don't follow it. So it's so important. I always like to teach trading psychology. It's helpful for me to teach, and I hope it's going to be helpful for you. And that one of these podcasts, I'll say something about it that you'll understand, that will resonate with you, and that will help improve your trading. That's the hope, right? And then after that, I did go down through my master watch list last night. I do it every Friday night. I go down through and I look for some potential trades for next week. I'm looking for confluences of levels that would be tested and rejected. Those include order blocks, those include major moving averages, those include RSI levels, those include V1s, V2 entry signals, those include double bottom bullish MACD divergences, ATR divergences, RSI divergences, and ideally all of those together. So I do have 8 particular potential setups for next week. Now they're not there yet, but they're within striking distance. And next week, if they do get to those levels and reject those levels, then I will consider entering the trade. So I hope that will be helpful for you to get an idea of, how I kind of stock a different not stock, but stock, these particular setup. Watch them carefully. I know exactly where I want to get in. If they do this, and if they do this, then I'm going to do that and get in. So hopefully that's going to be helpful for you. So if anything is you find helpful today during this podcast, or if you're learning something, I really would appreciate it if you could hit the thumbs up button. It really does help to build the channel, keep the channel around, lets YouTube know that there's some valuable content. But anyway, thanks again for coming to the podcast. And let's run this U.S. legal disclaimer, get this out of the way, and then we'll come back and we'll get started. So hang tight, please. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started on my first position which is SpaceX, SPCX. So I did enter SpaceX here on the 6th of August at 114.89, and great trade, obviously. Friday, it was up 15.83%. So why did I take this trade? It's interesting because when SpaceX went public, all the way back over here, I had so many calls from people saying, hey, Greg, should I buy SpaceX here? I said, I would not. I said, there's so much hype between it. I would wait for a pullback. And, then went up for a few days really strong, and then it came down and rallied, and then it kept going down. And people will call me, Greg, is it time to buy? Is it time to buy? Is it time to buy? And I said, no, I'm not buying until there's some kind of signal, until there's some kind of structure break to the upside to show me that buying a dip would be a good idea. And so the reason that I entered this trade here on the 6th was multiple reasons, but and I'll get into those in a second, but you can see this green box here. This green box is called an order block. And an order block, a huge majority of the trades that I enter, probably 90% of the trades that I enter, incorporate an order block, a green box like this. And so let me show you what an order block is. So the first thing we need to have for an order block is we need to have what is called a swing low. A swing low is simply a low that has a higher low to the left and a higher low to the right. So here on the 28th is a swing low, higher low to the left, higher low to the right. The next thing that we need is we need to find a swing high. A swing high is just the opposite. A swing high is a high that has a lower high to the left and a lower high to the right. So here we go. Here's a swing low. Here's a swing high. The next thing we need to find is another swing low that is lower than the first swing low. And here we go. Here's the swing low. Higher low to the left, higher low to the right. So we have a swing low, followed by a swing high, followed by a lower swing low. When all three of those components are in place, now I need to look back to that first swing high. And if in the future, after I have a swing low and a swing high and a lower swing low, if the market can move above that swing high, you can see this bar did it here, now we have a market structure change. We have a market structure change from a bearish market structure to a bullish market structure. Swing low, swing high, lower swing low, market structure change. Now, do I buy the market structure change? I do not. But the second we have that market structure change, now I can define my order block. And order block is the way that I do this. People trade order blocks differently. They set them up differently. That's totally fine. We all do things our own way. But the way that I do it, to make it simple, I just look at the lowest closing bar prior to market structure change, and now that is my order block. The high and the low of the lowest closing bar before market structure change is my order block, and I bring the high and the low of that order block into the future. So the idea is that once you have a market structure change to the upside, now I'm looking to buy a dip back in the order block. You've probably heard buy dips in an uptrend. Well, that is true. And the nice thing about order blocks is I know when it becomes an uptrend. In other words, when I have a market structure change, that puts me in an uptrend. So I'm going to look to buy the dip. All in this huge sell-off that we had down here, we never had a market structure change. That's why I told everybody that asked me, wait for a market structure change and then buy the first dip. That's exactly what I did, right? Swing low, swing high, lower swing low, market structure change. Now I'm waiting to buy the dip back into the order block. Here we go. And that's why I bought it. So there are multiple ways that you can use order blocks to get in. You can get in with a rejection of the high of the order block. You can get in with a rejection of the low of the order block. As a matter of fact, here on the 5th is a perfect example of a rejection of the low of the order block. You can see during the day, we went below the order block, but then at the close, we closed back in. Perfect. That's a rejection of the bottom of the order block. Now, I didn't take the trade here. I actually took the trade the next day on the 6th here at 114.88. So you might ask, why did you not take it that day? It's a good question. But the reason that I took it on this particular day was that we rejected both the low of the order block and the high of the order block, and we also had what is called a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes below bar 1's low and then closes above bar 1's close. And V1s and V2s are very helpful. I incorporate them in so many of my trades. And by the way, if you want to learn more about V1s, V2s, just go to my YouTube channel. I have a video that explains them in detail. So again, why did I take the trade here on the 6th at 114.89? Because we had a swing low, we had a swing high, we had a lower swing low, we had a market structure change. I waited for the pullback, and on the day that I took it, we rejected both the low of the order block and the high of the order block, and we also had the V1. So, okay, now that I entered the trade, the first thing I have to decide is how many shares am I going to buy? And this is probably your most important decision in any particular trade, is how many shares you're going to buy. Because if you buy too few, then it doesn't really matter. If you buy too many, then it's going to increase the stress of having too many shares, and you may not stick with your trading process. All right. So I use a very simple formula. I've used this for many, many years, and it consists of two different inputs. The first input is, how much is in my trading account? Let's just say I have $100,000 in my trading account. All I do is I take 1% of that. That is going to be my maximum allowed loss on trade. So if I have $100,000, 1% is 1,000. If I have a $50,000 trading account, it's 500. If I have a $25,000 trading account, it's 250. If I have a million, it's 10,000, right? So for this example, I just look, how much do I have in my trading account? Okay, $100,000. I'm going to allow myself to have a maximum loss of 1% of that. So 1% of 100 is $1,000. The next thing I do is I reference what the value of the 2 ATR is. An ATR basically is measuring volatility. How much is this stock moving each day or each week? And a lot of traders do not factor in the volatility, because the volatility today could be different than it was a month ago. So I get an updated reading every day on my 2 ATR. So if volatility is very high, it's going to have me buy fewer shares. If it's low, it's going to have me buy more shares. So 1% of my total trading account, 1% of $100,000, my maximum loss is $1,000. I take that $1,000, I divide it by the value of the 2 ATR, whatever it is on the day that I bought that. It changes every day. So I take 1,000 divided by 1886. This is telling me, Greg, with a $100,000 trading account, with a 1% maximum loss of $1,000 and current market volatility, the proper amount of shares to buy is 53. Great. I buy 53 shares. So I enter here, 53 shares. The very first thing I do after I enter is I take my entry price minus the value of the 2 ATRs, and I put this red line down here. This is my emergency stop. So essentially, if I enter here with 53 shares and it goes down 18.8, if it goes down the 2 ATR value on 53 shares, I have lost $1,000. This is my essentially my worst case scenario here. It can be worse if it gaps down, but most of the time, that's going to be my maximum loss. If I enter here and then it comes down and hits my emergency stop, I'm going to lose $1,000. But the good news is that only happens about 5% of the time. The other 95% of the time, if I have a losing trade, it will not be because it hit my emergency stop. It will be because it closed below my end of bar stop. And my end of bar stop is always going to be much closer to my entry price than the emergency stop. On this particular trade, my emergency stop is going to be a close below the low of this order block. So if the next day it had closed below this order block, even by a penny, I would be out. Would I have had a loss? I would, but would it be 1% of my account? No. it would be probably half of that, because my even if it got down here, because I did the math, I would have a 1% maximum loss. So my end of bar stop is going to be much closer to my entry than the emergency stop. Okay, so I buy here, rejection at the bottom of the order block, rejection of the top of the order block, plus a V1. I buy here, 114.89. I place my emergency stop, 2 ATRs below, right? My end of bar stop is going to be a close below the low of this order block. After I know where my emergency stop is and my end of bar stop, the next thing I do is I take my entry price, 114.89. Now I look to the value of the 1.5 ATR. Right now it's 14.15. What I do is I take my entry price plus this number, and I place this orange line above 1.5 ATRs above my entry. So what is this line? This is what is called my trailing stop level. So if I enter here in the future, if it gets to my trailing stop level, this puts me in trailing stop mode. And what trailing stop mode means is that if I hit my trailing stop mode now in the future, if I have a close below a previous bar's low, I'm going to exit half of my shares. And so, you've probably heard in trading that if you get into a trade and it starts moving up in the direction that you want it to, that you need to tighten up your stops. And that is true, because you don't want to, if you have a really good trade, you don't want to hold on to it and have it come all the way back. And so by going into trailing stop mode, I'm essentially accomplishing this same thing. So if I enter here and it gets to my trailing stop level, then in the future, if I have a close below a previous bar's low, I'm going to exit half. Now, have I moved my emergency stop? Have I moved my end of bar stop up? No, I have not. But by me going into trailing stop mode and selling half, it has the same effect of moving everything up. Okay, so far, everything that I've talked about, the emergency stop, the end of bar stop, going into trailing stop mode, these are all considered defensive moves, right? So if the market moves against me to my emergency stop, I have to take action. If the market closes below my end of bar stop, I have to take action. If I go into trailing stop mode and I have a close below a previous bar's low, I have to take action. These are all moves defensively. If the market is moving against me, I have to take this action. But I don't want to just play defense in my trading. I also want to play offense. It's just like any sports team. You can't just have a good defense but no offense, right? Or you can't just have a good offense and no defense. You have to have both. And so I do play offense in my trading, and let me explain how I do that. So I take a portion of my position off each day if it moves a certain amount from the previous bar's close. So I'm in this trade at the moment. So let me show you how I'm going to set this up for Monday. And this is really quite simple. All I do is I take the closing price of the day. Right now, the closing price of the day is 133.11. And now I look to the value of the 0.45 ATR. Right now, the value of the 0.45 ATR is $4.24. I simply take the closing price plus 4.24. My first profit target for Monday is 137.35. Put these in here. There's my first profit target. I place 3 profits targets every day. So the first profit target was the closing price plus the value of the 0.45 ATR. 137.35 is my first profit target. To get my second profit target, I simply take my first profit target, 137.35, and again, I add the 4.24. My second profit target for Monday is 141.59. And these are always going to be equidistant. 141.59. There's my second profit target. And like I said, I always place 3. So how do I get my third? I simply take my second, 140, 159, and again, I add the 0.45 to it. My third profit target for Monday is 145.83. There we go. Now, the question is, how much profit do I take at these levels? It's really simple. I just take 10% of however many shares I go into the day with at each level. So if I go into the day with 40 shares, I would take 4 off here, 4 off here, and 4 off here, right? If I have a really good day, maybe I hit 3. You can see entering on this on Thursday, I had a huge day on Friday, right? I hit 3 profit targets already. So I've already taken off 30% of the trade into this strength. I think it's very important to take a little bit of your position off when the market offers you something nice, because, if you have a decent day up, okay, maybe you hit 1 profit target. Okay, you take a little off. The market can't take that away from you. You've locked it in. You've reduced your position size. By reducing your position size a little bit, it takes stress off of the trade. And if you have less stress with the trade, you're more likely to follow the process correctly. So there's a lot of intangibles for me at least, in my opinion, of taking a little bit off when the market offers you something. So, if it goes down on Monday, I don't hit any profit targets. But then I'll have to recalculate the profit targets for the next day at lower levels, right? Because I base it off the closing price. So that's the offensive part. So here's my 3 profit targets. Monday, maybe I hit 1, maybe I hit 2. It'd be great if I hit 3, or maybe I hit none, and then I have to recalculate on Monday. So again, let's just kind of do an overview again of the trade. Why did I enter here on the 6th of August at 114.89? Simple. Because this was a rejection of the order block. Swing low, swing high, lower swing low. The key came here on this day when we broke market structure to the upside, putting us into a bullish market structure. Now I'm waiting for a pullback, a retest of that order block. I could have done it the next day, but I did not. I waited for Thursday and had a rejection at the bottom of the order block, rejection at the top of the order block, plus a V1, entered here, 114.89, emergency stop, 2 ATRs below, end of bar stop closed below the order block, place the trailing stop level 1.5 ATRs above, and the very next day, whammo, nailed it. Grateful for that. And again, sold into this strength. I am already at trailing stop level on the first day, which is a nice feeling. It's really nice to be at trailing stop level, because now what this means, going forward, if I have a close below any previous bar's low, I'm going to exit half of the remaining shares that I have. So this particular trade, big one, up 13.63% since I entered in one day. So very grateful for that, and good sign for SpaceX. IBM. All right, IBM has been a really nice trade. Interestingly enough, this does not incorporate an order block. Usually most of my trades incorporate an order block, but I did buy IBM back here on the 23rd of July at 206.65. Why did I enter this? Well, again, this doesn't have an order block associated with it. This is what is called a deep dip buy entry signal. And this had to do with the 30 RSI. Deep dip buys have to do with rejections of the 300-day moving average, the 250-day moving average, the 200-day moving average, and or a rejection of the 30 RSI. So on this particular day, during the day, the RSI went below the 30 RSI, but by the end of the day, it recovered and closed back above the 30 RSI. That alone is a legitimate deep dip buy signal. In addition to that, we had a V1. I talked about a V1 with SpaceX as well. Again, a V1 consists of 2 bars, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar one's close. So it rejected bar one's low and reversed. So the confluence of the signals there was an intraday rejection of the 30 RSI and a V1. So I entered here at 206.65, position size correctly. I placed my emergency stop 2 ATRs below, as always. My end of bar stop on IBM is if in the future, if it closes back below the 30 RSI, that is going to be my entry, because that's why I took the trade. It rejected the 30 RSI on this day. So in the future, if it closes back below 30 RSI, that's my signal to get out. So I entered here 206.65, emergency stop 2 ATRs below, end of bar stop is a close back below the 30 RSI in the future. I placed my trailing stop level 1.5 ATRs above my entry. Next day, took off in my direction. Grateful for that. It was a good start to the trade. Also hit some profit target, or hit a profit target into that move up, reducing my position size a little bit. Next day up a little bit. Next day up again. Really nice day up again, in which case I hit multiple profit targets and I got to trailing stop mode. Now, just because I'm in trailing stop mode doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to exit half. The next day down a little, but did not close below previous bar's low, so I did nothing. Here, the very next day on the 30th, I had my first close below a previous bar's low. After reaching trailing stop level, what do? I take off half of the remaining shares that I have. Remember, I'm taking profits into this moves up, so I have fewer shares than when I started the trade. So however many shares I had left, I took half and I locked in a profit of 6.76%. So if the market continues to go down, I will be glad that I sold half here. If the market continues to go up, I'm glad that I have half, right? Selling half is one of the best things. It's about the only win-win situation in trading. If it goes down, at least you sold half. If it keeps going up, at least you have half. So the next day we go up a little bit, next day up, profit target, next day up again, sold into that strength, profit target, up a little, then down, and then we were up a little on Friday, not enough to hit a profit target. So the remaining shares that I have on this particular trade at the moment, up 12.85%. So really good trade. And again, this one was a combination of a deep dip buy, an intraday rejection of the 30 RSI with the V1 as the secondary signal of the trade. So remaining shares up 12.85%. Silver. All right. So in the last two positions that I've shown you, I place my emergency stop, I have my end of bar stop, I go into trailing stop mode, I take partial profits. And the majority of my trades, that's exactly how I manage them. But there is one particular setup where I do the management a little bit differently, a little more simple, and that has to do with something called an abandoned baby or an island reversal. So if I can bring your attention to this bar here, you see how I've highlighted it green? Why did I highlight it green? Well, this is called an abandoned baby. An abandoned baby happens when you have a gap down. You can see here on the 16th, from the 16th to the 17th, we gap down. So overnight, the sentiment was very bearish. However, the very next day, it gaps up. So we have a very quick change in sentiment from bearish to bullish. And so the reason they call it an abandoned baby is because it kind of floats down here by itself. Gap down, gap up. Now, when you have this sudden shift in sentiment, in my experience, in my trading, and all the years that I've been trading, when this happens and you look in the future, more times than not, you are going to be higher after this happens, because that sudden shift in sentiment, there's a lot going on under the hood. You know, we could probably spend hours about why, but suffice it to say, when that happens, more likely you are higher then lower. So I bought here at $50.82. I position size like I normally do. I place my 2 ATR stop below, but I don't have an end of bar stop on this trade. I just have a 2 ATR stop. And how much do I lose if it gets down there? 1% of my account, right? But to the upside, what I do is I take my entry price and I add a 4 ATR profit target. So my profit target is twice as much to the upside as I'm risking to the downside. I'm risking 2 ATRs to the downside, and my profit target is 4 ATRs to the upside. And I buy this and I just let it go. Eventually, I'm either going to hit my 2 ATR stop, in which case I'll lose 1% of my account, or I'm going to hit 4 ATR profit targets, in which case I'm going to make 2% of my account, right? It's pretty fair to say that eventually one of these two things will happen. But with the abandoned babies, I know more times than not, I'm going to make 2%, then I'm going to lose 1%. So therein lies the edge. And, this is kind of a hands-off management style. I'm okay with losing 1%. Be great to make 2%. And I know more times than not, I will hit the 2%. So that's why I entered the abandoned baby, 2 ATR stop, 4 ATR profit target. It did take off, pulled back a little, and of course this week we've had a huge up move. Next week, if silver continues to move up and it hits my 4 ATR profit target, I'm done with the trade. That's it, and I'll make 2% of my account. So this particular trade, like I said, is kind of a hands-off approach. I'm either going to lose 1% or make 2%, that's for sure, just depends when. And this particular trade at the moment, based upon this bullish abandoned baby, the current trade is up 11.63%. Intel. All right. Intel is a order block trade. I entered Intel here on the 3rd of August at 91.03. Why did I take this trade? Well, we have this order block, and here on the 3rd, you can see during the day, we went below the order block and then we closed back in the order block. So that's a rejection of the bottom of the order block. So I entered here at 91.03, position size correctly, entered here 91.03. I placed my emergency stop 2 ATRs below. My end of bar stop will be simply a close below the low of this order block. You can see my entry point was very close to the low of the order block, so I have a good risk to reward. I placed my 1.5 ATR trailing stop level above. Next day, takes off. Good start to the trade. Sold some partial profits into that move up, right? Reducing my position size, but keeping the majority. The next day, got to trail, no profit targets, but we got to trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to get out of half. The next day down a little bit. You can see during the day we were below the previous bar's low, but we end up closing above, which kept me in the trade. And then Friday we were up a little bit, no profit targets, but up a little bit. So I am in trailing stop mode. I'm just waiting for a close below previous bar's low. This particular trade with the rejection of the bottom of the order block and the V1, see how the V1s help, is currently up 10.5%. So really good trades this week. Tesla. All right. Tesla, really good trade on Tesla. Entered here 7:30 at $308.81. Why did I enter? Well, you see the order block, the green box. This is from the past. But this was a very high probability trade here, and because it has a confluence of many signals. We rejected the bottom of the order block. That's one signal. On the day that I entered, we also had a deep dip buy, an under 30 over 30. The previous day, we closed under the 30 RSI. On the day that I entered the trade, we closed above the 30 RSI. So a rejection of the 30 RSI, deep dip buy. We also rejected the bottom of the order block. So that's an order block. These are two primary signals, deep dip buy and rejection of the bottom of the order block signal. In addition to that, if we zoom out here, something I like to use, I use it a lot, works well, is what is called a megaphone trend line. So a megaphone trend line, and I know this is kind of zoomed out, maybe a little bit hard to see, but a megaphone trend line is when you take a swing low and you connect that to a lower swing low. So here's the swing low, here's the swing low. I connect that trend line between this swing low and this swing low. I connect them. I take that trend line out into the future. Very often when you have one swing low and a lower swing low and you connect that trend line out, the third touch of that trend line generally creates a reaction to the upside. And so you can see this swing low, the trend line took months and months and months to get there, but look what happened. As soon as it had that third touch of that trend line, you can see the day before we closed below the trend line, and then on the day that it went up, it closed above. So that's a rejection of that trend line. So three primary signals: under 30, over 30, deep dip buy, check. Rejection of the bottom of the order block, check. Rejection of the long-term megaphone trend line, check. That's why I entered the trade. So I entered the trade here at 308.81. I position size, right? 1% of my account divided by the 2 ATR. I place my emergency stop, as always, 2 ATRs below. My end of bar stop is simply a close below the low of the order block. I place my trailing stop level, as always, 1.5 ATRs above. The next day, went up a little bit, went my direction, not enough for a profit target. Next day, nice day up. I did hit a profit target. Next day up again a little bit, not enough for a profit target, a couple days down. And then Friday, yesterday, we had a nice move up. I did hit a profit target into that strength. Not quite at trailing stop mode yet, but this particular trade currently up 6.14%. So really nice trade there. And then Friday, I entered a trade on Love on Southwest Airlines. So this is a completely different type of setup, one that I really like. It's called a higher low V1 or V2. In this particular case, it was a higher low V1. So let me bring your attention to these two green lines. See the top green line and see the bottom green line. Anywhere above the bottom green line, anywhere below the top green line is considered the value zone. Okay, it's kind of the mean reversion area. And so for this particular setup, the rules are that I have to at some point close below the bottom green line, which all these bars are below the bottom green line. The next requirement is that I have to have a rally back into the value zone. You can see these two bars came into the value zone. The third requirement is after it's come back into the value zone, I have to have a pullback, and that pullback is followed by a V1 or a V2. Now this is a V1 because it consists of two bars, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. So this is a V1. The reason it's called a higher low V1 or V2 is that this low, when this V1 was created, this low is higher than this low. And what you will see in trading is that higher low entries tend to easily, not easily, but they go up a lot easier, like legs up, than lower lows. What lower lows do is they bounce, yes, and then they pull back. Higher lows tend to have more of a stronger, easier time of moving up into a new up leg. So higher lows are always better than lower lows. And again, why is this a higher low? And what are the rules? We close below the bottom of the value zone. We rally into the value zone. We have a pullback, and then we have a V1 or a V2, and the bottom of that V1 or V2 is higher than this. So I entered here 47.05. Okay, I position sized. I placed my emergency stop 2 ATRs below, as always. Now, on a higher low V1 or V2, where's my end of bar stop? Well, the end of the bar stop here is at 46.64, very close to my entry. Why is it a close below this? Well, this is called the washout bar. The number 2 bar is always the washout bar. And what does washout bar mean? It just means that we went below the previous bar low. We washed it out and reversed. So from a Fibonacci standpoint, the halfway mark of that V1 or V2 has inherent support. So my end of bar stop going forward as if it closes below 46.64, which is halfway of the washout bar. And you can see how close I am to that. If Monday it closes below 46.64, I'm simply out, even if it's 1 penny, right? Okay, I was wrong. I took a loss, probably not going to be too big of a loss because my risk reward's so big. Remember, I have my 2 ATR stop all the way down here. The worst case scenario, I lose 1%. But this halfway of this V1 in this particular case, that's the real key level. And they've done back tests where if you close below halfway of that washout bar, you are more likely to go down than you are up. If you hold halfway of that bar, you're more likely than you are to go down. So it's this is great. It's a higher low V1. Higher lows are always better than lower lows. I have a good risk to reward ratio, had the V1, and so we'll just let this play out. So I am even on this trade because I just took the trade, but this is love. So I think that's it. I mean, it was a great week. Just recap, SpaceX remaining shares up 3.63%. IBM remaining shares up 12.85%. Silver remaining shares up 11.63%. Intel remaining shares up 10.5%. Tesla remaining shares up 6.14%. And then Southwest Airlines, which I just entered on Friday. So really great trading week. Grateful for that. Always grateful. And when I have a good week. So if you have any questions about any of these particular trades, just put them in the comment section. I'll do my best to get back to them. And next up, let's talk a little bit about trading psychology, shall we? All right, so this week's trading psychology post comes from Trading Proverbs. You can follow them over at X at Trading Proverb. Always like this channel. Trading psychology is such an important part of trading. It's the most important part, actually. And so, you know, I always like to read these because oftentimes I get something out of them, right? And so this one is kind of near and dear to my heart because honestly, everybody, I get so many people that call me and say, "Hey, Greg, where do you think this is going? Where do you think that's going?" And it's kind of like fingernails on a chalkboard for me. I'm like, how would I know? I don't know. So don't call me and say, "Hey, Greg, where do you think where?" I mean, I don't know. Either do you. None of us know. The market's chaos, right? All we can do, the only the edge in trading, in my opinion, is waiting for key levels to be rejected. That's the only kind of inkling you have to potentially get into trade. So before I go on my rant, let's read through this and see what this says because this sums it up nicely. It is always the best discretion to let the market show us where it is going and just simply follow. This would be prudent rather than predict where the market is going and place a position. This would be gambling. Anne Marie Baird. So many people, like I said, ask, where do you think this is going? I'm like, I don't know where it is going. If I, now it's just a prediction. As like Anne Marie said here, it's gambling. I don't want to be a gambler. I want to be a trader. I want to make good logic-based decisions. And let me tell you something. If you want to make money long-term trading, you are going to have to resort to this. So many people, oh, I'm going to gamble on this. I'm going to gamble on earnings. I think this is going up because this, that, or the other. Okay, great. But why not let the market show you that, giving you a little bit of a hint that a level has been rejected? So, in my trading, what do? I look for key levels to be rejected. That's the only clue that I have that the market said, you know what? We don't like the levels. We don't like the prices under this level. And so if the market doesn't like a price under a level, well, there's an edge that it's going to go the other way. So let's read it one more time. It is always the best discretion to let the market show us where it is going and simply follow. This would be prudent rather than the predict where the market is going and place a position. This would be gambling. And so waiting for key levels to be rejected falls in the let the market show us where it is going and simply follow. The market's rejecting this level, I'm simply following it. So, my best advice to everyone out there, quit trying to predict and let the market reject a key level before entering. Even if it rejects it, it doesn't mean it's going to go straight up, but at least it's giving you a little bit of a clue that the market, the aggregate market, has said, you know what, we don't like this level. That's your best chance. And that's it's the only chance you have. And, that's why I've been trading for 30 years, because this is what I do. So anyway, I hope you found this helpful, everybody, and you can follow Trading Proverbs at Proverbs over on X. All right, let's take a look at the potential trades that I have for next week. So last night I went through my entire watch list, and this is what I pulled up. Now, these are not where they need to be at the moment, but they're within striking distance. And I always say this every weekend, but listen, here I have 8 potential symbols. Is it possible that all 8 of these could trigger perhaps on Monday? Yeah, 100% all 8 of these could trigger. Does that mean I would enter all 8? No, it does not. I only enter one position per day. I don't care if there's 100 legitimate signals. I've got to narrow those down. I've got to narrow those 100 down to the best one. And so how do I do that? Well, I give a scoring system to each entry. So for example, if I have, just to make it simple, if I have one entry signal, I give it a score of 1. Maybe another one has a score, has 2 entry signals. I give it a score of 2. Maybe a next one has 3 entry signals. Okay, maybe I give that a 3. Problem is, maybe the one that has 3 entry signals, maybe the risk to reward ratio is not good at that moment. So now I have to deduct points, and maybe that's not the best one. Maybe the one that has 2 entry signals is better because it has good risk to reward ratio. So it's kind of it's a little bit of getting in there with a fine-tooth comb and a microscope and looking and trying to get the overall quality score of the trade. I also, like if I'm trading on daily timeframes, I'll also look to the weekly timeframes. Maybe everything's exactly the same on the dailies. Maybe I have 3 potentials. They have the exact same score on the daily. Well, I'll look at the weekly chart. Maybe the weekly chart will give me a clue that, look at this. On the weekly chart, I have a V2, or I have a rejection of some other key level on the weekly chart. And then that one would get the extra bonus point, and that is the one that I would take. Additionally, I look at relative strength. Perhaps the market is down across the board, but I have one that is up on that particular day. Well, that particular market is stronger than the rest of the market, stronger relative strength, and therefore maybe I give that an extra bonus point, and that's the one that I go with. So this is how I trade. This is what I teach my students, the fine nuances of picking the trade for that day. And if I could just take a couple minutes and just put in a quick plug and explain to you what I do teach, I do coach, I teach people all over the world, and I have done for almost 10 years now. I love to teach, and I love to teach my students how I trade. And so I do have a 20-hour course. The course is one-on-one. It's just you and I. We do 2 hours a week for 10 weeks. I teach you all the different trading approaches that I use. I teach you all the different rules that I use. And each week we'll look at the market together. We'll look at the setups, and and we do a lot of simulation trading, meaning that we'll just pick random markets, random time frames. I'll just run you through, okay, are you entering here? Oh, you are? Why? Where's your stop? Where's your exits? So forth and so on. I have taught, like I said, I've taught people from all over the world. I've taught people from all different skill levels, from absolute beginners all the way up to hedge fund level in New York and everywhere in between. So if you would like to learn to trade the way that I do, I would be happy to teach you. I would love to have you as a student, and I will teach you everything I know. The course costs $2,000, but really it's money well spent. You'll have a skill that you will be able to use the rest of your life. So if you're interested, just send me an email. My email is in the link of my YouTube video, and we can have a conversation. And like I said, I'd love to have you as a student. So send me an email, and we can get the conversation started. Additionally, if you like online courses, I have a really good online course available at udemy.com, and the link to that course is in the description of this YouTube video. I have a course there called the Deep Dip Buy Stock Trading Strategy. And we've talked about Deep Dip Buy today on my current positions. The course is 9.5 hours, and we go through everything, all the rules, all the setups on how to trade the Deep Dip Buy approach. It's really affordable. I think it's somewhere between $30 and $50. So that's a really good place to start. So two particular options: the 20-hour one-on-one course with me, 2 hours a week for 10 weeks, or the Deep Dip Buy. So either one of those options are really great, and I know will help your trading. So anyway, hope to have you as a student, and thanks for letting me put in my plug, and let's get back to what I'm looking at for next week. So first on deck is AMD. So AMD, you can see I have a order block here, a green order block. Again, why is this an order block? Well, look, swing low, swing high, lower swing low, market structure change. And it's worth noting, so as soon as we change market structure, we can define the order block. And then look, AMD moved up really strong. So when you're up here at the top and you look back to the order block, could you say in hindsight that smart money was buying here when it went up to here? Well, sure. Clearly, smart money was buying here when it moved to here. So the idea is, if smart money was buying here, went from here to here, in the future, if we come back to that smart money area, that may be a good place to buy again. Does it mean if it was smart money once that it has to be smart money again in the future? Absolutely not. Things can change, right? Economy can change, things can happen, change with the company. But I can tell you from 30 years of experience, more times than not, what once was smart money will also be smart money in the future, but not every time. That's why we have to have our stops. That's why we have to have our end of our stops. So what I'm looking at for AMD, and I don't know if it's going to get there next week at all. I never know, but I look at the chart and I mark everything up and go, where would I like to buy? Well, first off, the 100-day moving average, the red line, this is a key level. This is the 100-day moving average by itself is a key level. And the idea here is you have a key level within a key level. You have a key level, the 100-day moving average, within a key level of the order block. See, that's why these generally work so well. So now, look, we're not that close to the 100-day moving average at all, but I mark it up. So next week, if it happens, I can go, oh, hey, look, we are at that level. And so next week, if we come down and we reject the 100-day moving average for whatever reason, if the market sells off and rejects that 100-day moving average, I'll consider taking the trade. My end of bar stop will be a subsequent close back below that 100-day moving average. In addition to that, I put my own custom level in here at 409. This is the green line. Why did I put this line here? It has to do with these three bars here. These three bars are a V2, bar 1, bar 2. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. Okay. On a V1 or a V2, where is the inherent support? It's halfway of the washout bar. That's why I put this green line, because it's halfway of the number 2 bar. So I have two levels that I'm looking at for next week, either rejection of the 100-day moving average or a rejection of the 409 level, which is halfway of the washout bar. So somewhere in this area, I would, is possible that we could have some kind of bounce because these are key levels. But again, if it doesn't get there, I'm just not going to mess with it. But if it does come and reject these levels, I consider entering. If in the future we lose those levels, I'll simply get out. So that is AMD. Caterpillar, a lot of stuff going on with Caterpillar here. Remember when I talked about bullish band of babies? Well, we have one right here on 729. The previous day we gapped down, the next day we gapped up. When you gap down and immediately gap up, more times than not, you're going to be higher in the future. Was it right? Well, yeah, for the next 4 days, it was really right. It really did go up. However, now we are coming back down. And we're coming back down into this bullish band of baby. In addition, this bullish band of baby is also an order block. Why? Swing low, swing high, lower swing low, market structure change makes this the order block. So, and it's not just an order block, it's an abandoned baby. So now we don't have any moving averages inside this order block, but what we do have is that we have these trend lines. We have 2 different trend lines. Here's one trend line. Here's a higher trend line. 4 days ago, we broke above those trend lines, which is bullish, but very often when you break above a trend line, you will come back and retest that trend line before having another move up. So the question here on Caterpillar, and this is not, honestly, this is not a very clear chart. When I was going through this, I was like, from experience, it's very likely that after a pullback from here that it will bounce because there's so many levels. There's the trend lines that it could bounce off of. You're in an order block as well. But what I'm going to say, just to make it simple, I am going to be looking for a rejection of the bottom of this blue order block, and that's the bottom of this abandoned baby. So the bottom there is 776. So in next week, if we reject that 776 level and close back above, that would be my entry. My close would be a close back below that. So yeah, this one, if we had a moving average in here, it would make it a lot easier. But just to try to make this simple, we had an order, we broke structure to the upside. We have an order block below. I don't like the rejection of the top of the order block because there's too much risk to the bottom. So just to make it simple, a rejection of the bottom of the order block would be my entry signal, and the low there is 776 even. Costco. All right, so Costco has this new order block down here. Swing low, swing high, lower swing low, market structure change, lowest closing bar is this dude right here, the high and the low of that moving into the future creates the order block. Now it's kind of a tall order block. So there's no moving averages inside the order block. So I made 2 custom levels. The first custom level would be this kind of traditional trend line where we have this swing low and this swing low. We bring it into the future. There should be some inherent support if Costco comes back down and rejects this trend line. If that happens, I'll consider taking the trade. My stop would be a close below the low, or my stop would be a close back below that trend line. In addition, I put another custom level here at 920.60. Why? Because of these 3 bars here. This is a V2. Bar 1, bar 2, bar 2 goes below bar 1's low, closes above bar 1's close. The inherent support on that is going to be halfway, and that halfway is 920.60. So a rejection of 920.60, I would consider taking the trade, getting in, close back below 920.60, I would get out. The trend line, also possible. The thing with trend lines it's going to kind of move each day, so I just kind of have to take that on a day-to-day basis. But next week, if we do reject this particular trend line, and this trend line is about 927 up to 929, I could also enter with the rejection of that trend line, and my stop would then be a subsequent close below that. And so that's on Costco. Google, well, so Google had this huge run up. We've come back down. We have a half order block here on the 30th of July. I've highlighted the high and the low, brought that into the future. That by itself would be an interesting level. But what's interesting to me is that this 200-day moving average is going to soon get into that order block. And so if that, and so the 200-day moving average by itself is a key level, but this 200-day moving average is getting very close to the bottom of that order block. So you have two key levels here. So just to make it easy, if we reject the bottom of this order block, and that is at 330.34, I would certainly consider entering there using a close below that order block of 330.34 as my stop, or a rejection of the 200-day moving average. I would also take that just by itself because it's so close to the bottom of that order block. And again, if I entered with rejection of that 200, that would be the entry point, and then my end of bar stop would be a close back below the 200. So I'm going to watch Google very carefully to come back into this area here. Pepsi. Okay, we have an order block here. Swing low, swing high, lower swing low, market structure change. If we come back to this order block, this is a key interesting area. I also put a custom level in here at 134.50. Why? V2, bar 1, bar 2, bar 3. Inherent support is where? Halfway of bar 2, 134.50. So we have two important levels. We have halfway of a V2, 134.50, inside a key level of an order block. So I'm going to be watching this one very carefully as well. But my ideal would be a rejection of 134.50, and then I would use 134.50 as my key level. The Qs. All right. So I had an excellent short on the Qs here back in June. And I shorted here and had a great move all the way down. I exited the entire short here, thankfully. So we have what is called a bearish order block. The bearish order block is just the opposite of a bullish order block. With a bearish order block, you need to have a swing high, and then a swing low, and then a higher swing high, and then a market structure change to the downside. When that happens, you can identify your bearish order block as the highest closing bar before market structure change. Bring this into the future. See, we broke market structure, rallied back to the bearish order block. That's why I shorted, and really it nailed it. Well, I'm surprised we are getting back again close to that shortable area. So just to kind of make it simple, if we get back and reject the bottom of this bearish order block, I would certainly consider getting short again to ATR stop, and my end of bar stop would simply be a close above the high of the order block. And the high there is 746.44. So looking for a potential short on Qs, not because I'm trying to predict that we're going down. It's just that this is a bearish order block. We've broken structure. We rallied, like I said, on this short here, we rallied, and that trade just nailed it. Doesn't mean that if we come back up here, it has to nail it again. It will be right. It could just blow through this and make all-time highs. Could. Not sure. I don't know. All I can do is take my signals. But just to make it simple, I'm looking for a possible rejection of the bottom of this order block about 739.17. I would potentially get short there. 2 ATR stop above, end of bar stop, close above the high of that order block. Natural gas, UNG. All right, well, we are pretty stinking low on UNG. Really, really low. I talked about megaphone trend lines where you have a swing low and then another swing low and you connect those together. Well, this swing low connected this swing low going out into the future. when it had the third touch of that trend line, it did bounce for 3 or 4 days. But now we are getting close to another touch of that line. In addition to that, on Friday, we had a bullish abandoned baby. Look, on Wednesday, we gapped down. On Friday, we gapped up, making this an abandoned baby. So could I have gotten into this trade based upon that abandoned baby on Friday? I could have. I could have just gotten in, placed a 2 ATR stop, placed a 4 ATR profit target, but I took, what did I take? I took Southwest Airlines instead. But it doesn't mean that UNG is not off my radar. Now, we created a V2 here on Friday, bar 1, 2, 3, 2 goes under bar 1's low, 3 close above bar 1's close. So the halfway, which is Thursday, is a key level here, 964. Next week, if we do reject 964, probably the way I'll play it is if we reject 964, I'll get in, emergency stop, end of bar stop. But my end of bar stop would be a close back below 964. But, big picture, there's a lot of things going on here. We had a bullish abandoned baby. We are running into the level of the fourth touch of this megaphone trend line. And in addition, it is really, really low. So that's what I'm looking for there. And then last but not least is VIX. So VIX has just gotten hammered. Poor VIX has just gotten hammered. Now, VIX goes down when the market goes up, right? VIX is volatility. But what I'm looking for, there's two things I'm looking at VIX here. The first, we have this megaphone trend line. The swing low, these swing lows. We bring this out into the future. If VIX next week gets down near the third touch of this megaphone trend line, it's likely to have a reaction. Doesn't mean it has to, but it's likely. If it has if the VIX has a reaction there, what do you think the market's going to do? Very likely the market will go down. We're also in the low RSIs at the moment. We're 38.75. We're also, if we get to this third touch of the megaphone trend line, we're going to be very close to the negative third ATR channel. Remember, 92% of prices when they get to the negative third ATR channel tend to stop going down, move sideways, or bounce up. So I kind of like VIX at this extremely oversold level here. But I would need, at this point, I would need a rejection of this megaphone trend line. It's like 1957 or a potential under 30 over 30 as well. So that's what I'm looking for. With the market being up so much, there's not a lot of super clear-cut signals for next week. That's why on some of the some of these, I'm relying on the megaphones, and they're not as precise signals. That's why I spent a lot of time talking about, well, if it does this, like Caterpillar, right? If we look back to Caterpillar, I just from experience, I know there's a lot of levels here, but there's not a lot of clear levels that are a little bit harder to articulate. So I'm having to kind of go out a little bit. Usually in the podcast, I'm able to give exact numbers, but on this one, it's more like, well, this is kind of a general area because. So anyway, so excuse me for that, but it's just, there's just not a lot of clear signals. It's more just zones and areas that feel good to me. So anyway, listen, everybody, I appreciate you being here. I hope you found something useful in this podcast. If you did, I appreciate if you could hit the thumbs up button. I always like to leave off with, if you have the chance or the opportunity to do something nice for another person each day, please do it. We could use a lot more of that in this world, right? I mean, we like when somebody does an act of kindness for us, and we appreciate it. So if you have the opportunity, why not do it for someone else? It's a win-win for them, for you, and for the world. And I'm a big animal lover. I was raised with many animals, and animals appreciate act of kindness just like we do. So if you have the opportunity to do an act of kindness, one nice thing for an animal to better its day, go ahead and do it. It's just good. It's just good energy, right? It's just a good thing to do, and they appreciate it. You'll appreciate it. It's a win-win all around. So I really appreciate being here, everybody. If you have any questions or comments, please let me know, and I will do my best to reply. But thank you so much for coming here. And have a good rest of your weekend. And God willing, I'll see you next week. Take care, everyone.
U.S. government required stock options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.